The rules on inheritance tax are changing, and they're changing fast. So following the October 2024 budget, major reforms to inheritance tax are due to take effect in April 2026, and the time to act is now. So these changes will impact business owners across the UK, especially those who own limited companies, family businesses and farms. And it's critical to understand what is changing and why acting early and taking a proactive approach to succession planning could save your family from a costly tax bill. So two of these very important changes are the business property relief BPR and the agricultural property relief APR. So currently APR and BPR can reduce inheritance tax on qualifying assets up to 100%. Now for business property relief, these assets would include business assets in a limited company, shares, partnership capital accounts, for example. And for agricultural property relief, that would include assets such as agricultural land and farm buildings. Now, previously there's been no limit to the values on these assets that would attract 100% relief from the IHT. But from April 2026, the current 100% relief rate will be capped at the first £1 million worth of value, with only 50% relief on amounts above that. So any value above £1 million would actually only attract a 50% relief, which basically results in a 20% tax charge because the main rate of tax is 40% on IHT. That's what its effective 20% tax rate on the company share value, for example. Now those limits apply per individual. So what do you need to consider? Well, it raises the obvious questions around succession planning and who the right people are to be holding share values and ownership in the company and the business. So you're not exposing the business unnecessarily to the misfortunes of a very large, costly IHT bill. Now might be the right time to make those necessary changes. Now, numerous ways that this could be done. Some of these options will be significantly curtailed after April 2026. An example of this is putting shares into trust. Now, just a note on trusts, they can be a key tool for IHT planning because they enable individuals to remove assets from their personal estate, and they can control their distribution, potentially reduce or eliminate that 40% IHT liability. But the October 2024 budget brought some important changes to trusts and their effects on IHT planning going forward. So just to outline these changes very quickly, BPR and APR assets can be transferred currently into and out of trust without triggering IHT, and trustees don't pay IHT on the 10-year anniversaries of trusts. But from April 2026, that will be changing, and the changes to how that will apply needs to be reviewed prior to April 2026. There was trusts before the budget day in 2024 will have its own £1 million allowance, but trust after that has got some slight complications around. Exit charges in relevant property trusts will also be changing as a result of these new rules, but there's currently a window open until 5th of April 2026 to consider the use of trusts for succession planning and IHT mitigation strategies before April 2026. Another example of what you might need to change regarding IHT is making changes to your wills to ensure you don't get caught out. The most important thing, however, is to not leave it too late. You cannot wait until nearer April to be considering taking action to reduce your IHT. These IHT changes are hugely significant, and there is a small window of opportunity right now to make changes while you can. And our team of business and tax advisors are experts in helping businesses through these tax changes and also the important aspects of succession planning in owner-managed businesses. I would urge you to contact us to discuss with one of our advisors what the right next steps are for you and your business.